Hello everybody, welcome to the first in a series of short videos I'll be putting together on the subject of investment management fees. During these sessions I'm going to be talking about the different types of fee that can be applied, how they're calculated, and what to look for when assessing the fee methodologies underpinning those calculations. My aim with these sessions is to give everyone a solid understanding of how fees work from the ground up. So let's start with the basics. Before I start talking about investment management fees though, I want to begin with a brief introduction to what it is that investment managers do. And it's pretty simple. They create and manage investment portfolios, using their market expertise to select a mix of assets that maximize returns relative to their clients' specific objectives, risk tolerance, and investment horizon. But how do they go about it? Well, it begins with the client. Before an investment manager starts to do anything, they need to understand what their client is looking to achieve and the risks that they are willing to accept to achieve it. Only once they understand that can they start work on the best way to meet those objectives, a process that includes deciding the appropriate distribution of assets across various categories, including equity, fixed income, and alternatives, researching and selecting specific funds or securities within those asset categories, and identifying and managing any potential risks to the portfolio. In addition to creating portfolios for individual clients, investment managers can also create funds that their clients can invest into. By pooling investments from a number of underlying clients, investment managers can create funds that operate at a scale that might not easily be achieved by any of those clients acting individually, due to, for example, the number of assets involved or the minimum size of investment into those assets. To illustrate, let's imagine a fund made up of the following. In order to allow clients to easily invest in the fund, the investment manager issues units of it, with each unit representing a portion of ownership of the fund as a whole. Think of them as shares in the fund, and groupings of units being split into different share classes. Each share class can then be treated differently based on the client needs it was designed to meet. For example, clients holding units in an income share class would receive regular payments representing their portion of dividends or coupon payments made by underlying holdings of the fund, whereas clients holding units of an accumulating share class would see the value of their units increase more over time, as those same dividends and coupon payments were instead reinvested in the fund. Share classes can also be subject to different fee treatments, with some charging fees within the unit price and others not. I'll go into more detail on that shortly. So now I've talked about what investment managers do, but how do they make money? Well, they charge investment management fees. These fees compensate the managers for their time, services, and expertise, as well as covering the operational and administrative costs associated with managing client investments. At their simplest, they take the form of a base fee, which is usually, though not always, expressed as either a percentage or as basis points, or BIPs, per annum, with each basis point being equal to 0.01% of the value of the client's holdings. Base fees can be charged either at the portfolio level, meaning that the fee is a percentage of the total value of the client's holdings in that portfolio, or at asset level, with the fee being calculated as a percentage of the value of each of the assets, usually in these cases investment funds, held within the portfolio. The base fee rate applied depends on a number of different factors, including, firstly, whether the investment manager is making investment decisions and placing trades on the client's behalf, known as discretionary management, or whether the client is making the investment decisions, with the investment manager unable to trade without their specific instruction, known as non-discretionary management. Typically, portfolios that are managed on a discretionary basis incur higher fees than those managed on a non-discretionary basis. Secondly, if the client has holdings of investment funds, whether those funds are actively or passively managed. If the investment funds are actively managed, the fund manager aims to outperform a specified benchmark, requiring significant research, analysis, and constant monitoring of market conditions and individual investment performance. Conversely, if the investment funds are passively managed, the goal is to instead match and track the performance of a specified benchmark, typically Passively managed funds have lower investment management fees than actively managed funds. And, lastly, depending on the costs involved in creating and managing the fund or portfolio, which can vary significantly depending on the complexity of the financial instruments used and the types of assets involved. Also, in addition to base fees, investment managers can also charge performance fees in relation to actively managed investment funds or portfolios that are managed on a discretionary basis, with the performance fee varying depending on how well the investment fund or portfolio performs against a predetermined benchmark. I may go into more detail regarding performance fees in future sessions, but for now it's important to recognise that they can exist and that where they are used, the base fee is lower than instances where there isn't a performance fee in place, with the expectation being that the performance fee will make up the difference. It's important to note that base fees can be charged in different ways depending on the level at which they're calculated. If they're calculated at portfolio level, then they have to be charged externally, which is to say outside of the portfolio, and are calculated and invoiced to the client based on a frequency that's set out in their investment management agreement. If, however, they are calculated at asset level, while they can be charged externally, if they relate to holdings of certain share classes of investment funds, they can also be charged internally within the unit prices of those funds. Let's start by looking at internally charged fees in a little more detail. These fees are typically calculated and accrued on a daily basis and, excluding performance fees, can be split into two components: the investment management fees, sometimes referred to as the annual management charge or AMC, and fund expenses, including custody and audit costs that are not paid to the investment manager and are in addition to and not part of the investment management fee. Taken together, these form the total expense to the client of holding the investment fund, typically referred to as the ongoing charge figure or OCF. As fund expenses are flexible and may vary depending on what's going on within the fund, most investment funds tend to charge based on a fixed AMC rate, which is detailed in the applicable fund documentation, along with a note saying that fund expenses will be charged within the fund, in addition to the AMC, and will fall within a stated range. There are, however, exceptions to this, with electronically traded funds, or ETFs, share classes of some investment funds, and most cash funds instead charging based on a fixed total expense. As the fund expenses charged in relation to such funds and share classes remains variable, fixing the total expense in this way means that the AMC within these holdings also has to become flexible to compensate. So now we know how internally charged fees are broken down, let's look at how they're applied. Taking a simplified example, let's imagine that we have an internally charged share class with a total value of 100 million, 10 million units priced at £10 each, and an AMC of 50 basis points per annum. Assuming that there are no fund expenses and that the value of the investment fund doesn't change as a result of market movements, the base fees charged within the fund over the first 5 days would be as follows. At the start of day 1, the share class has a value of 100 million, and the fee for that day is calculated by applying the annual rate to the valuation and dividing the resultant figure by 365, giving us a day 1 fee of £1,369.86. This is then subtracted from our starting fund value to give us our end of day value. Given that the number of units in issue hasn't changed, this decrease in fund value means that the value of each unit of the share class will also decrease, with the new unit value being calculated by taking the end of day fund value and dividing it by the number of units in issue. Repeating this process for the next 4 days, we can see the following. The total fee accrued comes to £6,849.13, representing the total base fee paid out of the assets of the fund to the fund manager over the 5-day period. As the fee is paid directly out of the assets of the fund, it cannot be varied between those holding units of the share class. Everyone who holds them is impacted by exactly the same fee. Finally, let's take a look at externally charged fees. As fees of this type are calculated at a client level, there is significantly more flexibility in terms of how they're calculated, beginning with the fee structures applied when calculating them. If, for example, we take a 100 million investment being made into an externally charged share class of the investment fund we discussed previously, with the same assumptions being made regarding fund expenses and market movements, the externally charged base fee over the 5-day period could be calculated by applying a number of different fee structures. To begin, instead of being based on a percentage of the value held, it could instead be based on a fixed annual amount, which would remain static regardless of the value of the client's investment, with the base fee over the 5-day period being an apportioned annual value. Alternatively, the fee could be calculated on a percentage basis, either by applying flat annual percentage rates in much the same way as it is within the internally charged share class, though the actual rate applied doesn't have to be, and in fact very rarely is, the rate applied within the internally charged share class, or by applying something like a tiered fee structure, with the different fee rates being applied to different portions of the client's investments depending on the total value held. It's important to note here that while I have chosen fee rates and values designed to produce the same total value in each of the examples above, the structures I have used will react very differently to changes in the client's holding value over time. The flexibility created by the use of externally charged fees doesn't just apply to the rates used to calculate them either. The fact that they're not calculated internally means that there is additional flexibility in terms of how frequently they're calculated. Internally charged fees tend to be calculated daily, but externally charged fees can be calculated daily, monthly, quarterly, or even over longer semi-annual or annual periods. The valuations used. Internally charged fees are based on the valuations determined by the fund administrator, but externally charged fees can be based on other valuations, including those determined by either the investment manager or the client's custodian. The valuation frequency. They can be based on daily valuations, but monthly, quarterly, or even annual valuations can also be used. What's included in the calculations? So internally charged fees are based only on the value of that specific investment fund, but with externally charged fees, the value of other client holdings can be taken into consideration when determining the rate applied to the holding in question. How cash flows into and out of the client's investments are taken into consideration. So internally charged fees, being calculated daily, take the impact of all flows into consideration, but this is not always the case with externally charged fees. As all of these elements can vary from client to client, they need to be covered in each client's agreement with their investment manager. I'll go into further detail regarding all of the above, as well as the fee structures I talked about previously and how they might be applied, next session. So to close out this session, let's quickly go through what we've covered. We've looked at what investment managers do, how they charge base fees, the level those fees can be charged at, and some of the factors that impact them, and that base fees can be charged either externally or, in some cases, internally, and the differences between internally and externally charged fees, which I've summarised in the table below. Thank you all very much for your time and attention during this, and I hope it's been useful to you.